In this video, I'm going to talk about partial year depreciation. If a company purchases an asset in the middle of the year, they likely won't want to depreciate the asset for the full year in that first year. So that's what I'm going to talk about in this video. And I'm going to use this example of equipment that costs $12,000 with a zero residual value and a useful life of 10 years. And I'm going to use straight line depreciation just because it's simple and straightforward, and it will be easy to demonstrate this with straight line. Okay, so if you're using straight line depreciation, the first thing you would want to do is calculate depreciation for the full year. So you would use the formula, and the formula is cost minus residual value divided by useful life. So $12,000 minus zero residual value divided by 10 years. And that's going to give you a yearly depreciation of $1,200 per year. So every year for 10 years, they would depreciate this asset for $1,200. And they would typically record the depreciation at the end of the year. Well, let's say, for example, they purchased this asset on April 1st. They wouldn't want to depreciate for the full $1,200 in that first year because they didn't own the asset for the full year. They didn't own the asset in January, February, or March. So in this case, they would depreciate for a partial year. And what you would do is count April because it was at the beginning of April. So you do want to count that full month of April. If this had been April 30th, you would probably not count April and you would start in May. But since it was on the 1st, you're going to count April and then every month after that up to year end. And we're assuming a December 31st year end. So that would be April through December of that first year, which is 9 out of 12 months. So to calculate the partial year depreciation in the first year, they would simply take $1,200 times 9 over 12 to get an amount of $900. And it's as simple as that. Now, what you could have done was, instead of dividing in the original formula by 10 years, you could have divided by 120 months, and that would give you a depreciation amount of $100 per month, and then just multiply that $100 a month times 9 months. So that's another way to calculate this, but whatever's easier for you, whatever makes more sense to you is what you should do. But I'm just going to assume that you're multiplying by the fraction to represent the partial year in this situation. Okay, so what would happen in year one? They would depreciate the asset for $900. And then years 2 through 10, they would depreciate for the full $1,200. And what's going to happen in this situation is they're still going to have a little bit left to depreciate in the 11th year. So I'm going to actually write out all the years so you can see exactly what I mean. So we're just going to assume that they purchased this on April 1st, 2025. So that means in 2025, it was $900 of depreciation. And then for the next years 2 through 10, which would be years 2026 through 2034, they would depreciate for the $1,200. So I'm going to actually write out all those years. Okay, so what I have here is in 2025, they only depreciated for April through December, or $900. The rest of these years, years 2 through 10, it's $1,200 for the full year of depreciation. And if you were to add up these amounts, you would get a total of $11,700. Well, the maximum they want to depreciate this asset would be $12,000. In the last video, I talked about how the top of this formula, the cost minus residual value, represents the depreciable cost. And this is the maximum amount you want to depreciate the asset. So they want their accumulated depreciation account to reach the $12,000. And at this point, it's only 11,700. So what that means is in the 11th year, they're going to need to depreciate $300. And this simply represents January, February, and March of that 11th year. And this will bring their depreciation to the full 10 years from the purchase date. Okay, so year 11 would be $300. Now, if you notice, I didn't talk about what to do if they purchase it in the middle of the month. I only talked about the first of the month, and then I mentioned the end of the month as well. If it was at the end of the month, you would have done May through December, and this would have been 8 out of 12 months or $800. But I didn't talk about what you would do if it was on the 12th or the 15th or the 22nd or some other random date in the middle of the month. The reason why I haven't talked about that is because I'm going to address that at a later point when I get into some of the more in-depth topics of this series. For now, I want to keep it simple because we're just starting to talk about depreciation. I'm going to come back to depreciation at a later point in this series. And that's all I wanted to cover in this video. If you have any questions, feel free to comment below, and thank you for watching.